Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Nicola Higgs, a financial regulatory lawyer in Latham & Watkins's London office. In this episode, we're going to discuss the Leeds Reform package announced in the Mansion House speech made by Chancellor Rachel Reeves on the evening of Tuesday, the 15th of July. The financial services sector strategy launched in parallel, and what the announcements mean for UK financial services. I'm joined by my colleague from the London office, Rob Moulton, to discuss key takeaways for financial services firms. Rob, welcome to the podcast.
Thank you, Nicola.
In Rachel Reeves' own words, the Leeds Reform package represents the most wide-ranging package of reforms to financial services regulation in more than a decade. Rob, earlier today, you presented on the reforms to over 200 Latham clients, representing a good proportion of the UK financial services sector. What's the initial reaction of the market to such wide-scale reform proposals?
Well, I think the reaction is a positive one in that the right diagnosis has been come to by the government, that the cumulative effect of regulation has got too great, that has become anti-competitive, and that constraints on the financial services industry are bad for the economy as a whole. And so I think from that point of view, the industry is behind the need to reform. Now, everyone then might have their own view on exactly how to line up any particular measure or where the highest priorities should be, but I don't think there is any doubt in the industry's view that this is an overdue and major reform package, even though they realise that will give both them, the government and the regulators a lot of hard work to do over the next year or two.
Thanks, Rob. And it's interesting Rachel Reeves making this speech 1 year into the new Labour government taking power. And based on what she said last night, what insights do we have on this Labour government and the landscape it's trying to operate in?
Well, it's very aligned with the government's overall growth and international competitiveness strategy. So I think that's a starting point. It's really taken a year to get to solid proposals. These things aren't easy. Major reforms often aren't, but it feels as though some of the work has been done more recently than in preparation for government. I think one really important point to note in this package is in several areas, the government is asking the regulator to take over the reform package. And actually, for most of the first year, there's been something of a tetchy relationship, in my view, between government and regulator, and they've occasionally each gone public about it, where the FCA in particular has been accused of being risk averse. There have been highly critical reports, in particular from the House of Lords Financial Services Committee, and where the FCA has occasionally asked the government for more clarity on risk appetite. But it's like a line has been drawn under all of those discussions, and we've now reached a point a year in of alignment between government and regulator that change needs to happen, and the regulator is again going to be trusted to lead some of it rather than the government feeling as though perhaps it's having to force the regulator into action.
That's really interesting. Thanks, Rob. And so to what extent do you think recent parliamentary criticism has fed into the proposals?
I think quite a lot, and I think the government has picked it up, and I think that so have the regulators. And some of the language, I mean, I've already used some of it. It's becoming now commonplace, the cumulative burden of regulation, that type of terminology, the need to regulate for growth and for risk. At the same time, not just regulating risks, but trying to work out how to promote investment. That type of terminology, straight from Parliament, straight into the Treasury document, straight into the FCA and the PRA consultations. So it's clear that parliamentary criticism is influencing not only the terminology, but the direction of travel.
Thanks, Rob. So now let's get into some more of the detail of what is discussed in the Leeds Reform package. And one of the things I found interesting is that Rachel Reeves led with calling out one of her biggest reforms being to the Financial Ombudsman Service, the FOS. Why do you think this is a particular area of focus?
Well, it's one where she can align with industry, and I think that's important. The industry's view that the FOS, in trying hard to do a difficult job, can sometimes come up with policy positions that cost the industry a lot of money. And so industry and now government say that this has led the FOS to become a quasi-regulator. That criticism may be unfair. It's probably been looking at cases and saying, here's what we think, and any other case that falls into this category, we will think similarly. And there can be very large numbers of cases, like motor finance, and that can lead to very big bills. But I think it's important for that to be a lead element for the Chancellor, because she wants the industry to have confidence that regulation will be predictable and that the FOS will not come to a view which might be contrary to the FCA's rules in the interests of fairness. So, one big change there. If a firm is following the regulator's rules, that will by definition be a fair and reasonable thing to do. And so the FOS is going to have to know the technical details of the FCA's rules to be able to do its job. And alongside measures like changing by lowering the interest rate payable on claims, limiting claims to a maximum 10-year look back, they're trying to limit the extent to which the FOS could have an impact on the industry, rather than being what it was set up to be, which is an arbitrator for individual disputes.
Thanks, Rob. And I think as practitioners, one thing we've always seen is a government and a regulator in the UK that is very willing to regulate for risk in the context of retail markets more broadly. What else is in the Leeds reform package that points to a regulator thinking more of growth in the context of retail market regulation?
Well, I think two key points. The first is the new regime on the advice guidance boundary review for targeted support, enabling firms to give limited advice to generic groups of consumers with common characteristics. And that's very much something they're trying to do for ISA season in order to be able to try to promote investment through stocks and shares ISAs. They've sort of push back further consideration around the cash ISA regime. But that's one crucial area where the industry has agreed to help the government promote the benefits of investing in stocks and shares through ISAs and being able to provide targeted support where the rules are much more limited than for full holistic advice. That's one really important proposal. The second in this area, consumer duty, where the government has asked the FCA and is trusting the FCA to carry out a review to say, is the consumer duty having too much of an impact on wholesale markets? Clearly, its key design is to help retail businesses service their customers properly, but is the distribution chain approach impacting elsewhere? And can the FCA go away and reconsider whether that regime can slightly shrink to fit what I see as the government's objectives for its scope?
Thank you, Rob. And thinking on another key theme that came out for me from the speech at Mansion House was a government very focused on being internationally relevant in its policymaking. Rachel Reeves was keen to make clear the government's focus on being outwards facing on its approach to reg policy, noting the presence of the US SEC Commissioner, Hester Peirce, and the EU's Financial Services Commissioner, Maria Louis Albuquerque, in the room at Mansion House to hear her speech, and highlighting trade deals with India, China, Switzerland. The focus is really on supporting strong multilateral institutions. One example of this is the global Basel III framework, which are global banking standards designed to strengthen the financial system. How is the UK looking to develop its framework on bank capital in line with its growth agenda?
Well, it's looking to bring clarity to the industry and say, this is the plan, and we're going to try now to stick to it. And that is, confirming the approach to Basel 3.1 and that various dates, Jan 27, Jan 28, for parts of that to come in. But it's therefore grappling with making sure that smaller challenger institutions are not adversely affected where they're primarily domestic, and trying to make sure that our international businesses are in line with international standards and that the UK doesn't end up going beyond them or being the only people fully to implement them on time. So some flexibility on timing and some on implementation. The headline one there has probably been MREL, where the indicative thresholds will be raised from the current 15 to 25 billion to 25 to 40 billion to give domestic institutions a greater period of time before MREL kicks in, while staying aligned with the international standards involved too. There are a number of important bank capital reforms where we are looking internationally and trying to make sure we align. Ring fencing regime will be another where something of an outlier now there. And rather than removing that regime, the government at least wants to allow ring fenced institutions to provide more products and share more resources. I was particularly interested as well, Nicola, you mentioned it. International guests in that forum get well received in the city. The city understands how international it is. And I think it's pleased that the government's able to build better relations, in particular with the EU, in financial services.
And continuing that theme, Rob, let's shift to thinking about London's place as a globally significant listing venue. And again, Rachel Reeves is keen to point out that the FTSE is at an all-time high for the first time ever, breaking 9,000 points, and that London is home to the deepest equity capital market in Europe, with the London Stock Exchange being the most international in the world. So what are we proposing in terms of capital markets and prospectus reform?
Thanks, Nicola. Well, I think this has probably been the largest, the poster child of all of the reforms for the last few years. Major reforms to the listing regime and to London as a listing and capital market centre to make it match fit for an internationally competitive environment. The legislative reforms are now final with the prospectus regime changes, and so that's everything from increasing from 20 to 75% the amount of a secondary raise that can be undertaken without a prospectus, through to making the process and the prospectus part in particular more straightforward when businesses are listing. And we do have signs of London as a capital market returning, of listing interest returning to London. And we now have a regime which makes it a really attractive location on an international comparison basis when you're comparing the rules. And there's definitely a big focus on the government for making sure that is a world that functions better in the short term going forward.
And probably one of the areas our clients have been asking us most about is the direction of travel on the reform of the senior managers and certification regime. What's the headline on that, Rob?
Well, I think the key headline is actually that we're delaying to a phase two, the core consultations on how many senior managers do firms need, and whether the certification regime will be scrapped or majorly reformed. So the government has said they're going to remove the legislation covering those areas, and again, trusting the FCA by transferring it into the FCA and PRA rules to make reforms to the existing regime. But we don't know what they're going to be yet. The expectation is there may be fewer senior managers, and of those that remain, only a subset may need the FCA's prior approval, so that type of reform, but we just don't know. There are other areas under SMCR where we do now know much more about what is likely to happen. One good example, I think, is at the moment there is a 12-week rule which enables firms where there is an unexpected absence of a senior manager to have someone cover it for a 12-week period and hopefully get approved within that 12 weeks. But that period's too short. So the reform proposal is to say that firms will have 12 weeks to put in an application for a new candidate, and the FCA will then have its newly reduced statutory period, a couple of months, to look at that application. That's exactly the sort of practical measure, I think, on SMCR that firms were hoping for. Two further areas. First, the SMF7 regime. These are overseas senior managers who don't hold a formal role in the UK entity, but are so influential that they get captured by the regime. And new guidance has been given. The example is of a group CFO and their interactions with a local UK entity CFO on when will the group CFO be caught, and some further guidance that I think firms will find helpful. It may not be perfect, there could be lobbying on it, around when does a firm have to give a qualified reference to an individual who has left part of the way through an investigation, and where the terminology is that firms don't need to update a reference around unproven allegations. And so some important improvements to the regime, but the fundamental changes to it, the ones that we think of as lightening the regulatory burden significantly, they're up for future consultation by the FCA.
Exciting times. So, a lot of detail in terms of regulatory policy change on a look forward basis. How does that represent a change in the government's thinking since November 2024 and that Mansion House speech?
Well, Nicola, I think it involves detail. I mean, Mansion House set out the same diagnosis and the same policy aims, but without prescribing the medicine. And I see the Leeds reforms as the medicine, following on the diagnosis. So it's as though the government's thinking has evolved, but they've spent the time wisely. They have spent the time engaged with the regulators and with the industry. And because reform really requires all three to work in sync: government to back the proposals, regulators to lead them, industry to implement them. Now, you mentioned at the start of this podcast the statement that this is the most ambitious reform proposal for a decade. It is worth just fact checking that. I suspect that if you looked at these proposals and you looked at the previous government's Edinburgh reform package from late 22, they'd be similarly ambitious. But if I had to pick out a difference, it wouldn't necessarily be in the ambition or in the scale of the changes that were being proposed. It's in the alignment that we now have, but perhaps did not have in 22, between government and industry and regulators as to the urgent need to do something. And therefore the time scale. I think not only do we now have ambitious reform proposals, but we have a time scale in which we are told this is now going to happen with urgency, and the time with which these measures will come through is likely to be as much a part of a surprise and the way people look back on this package as the size of the reform proposals as a scale overall as well.
So, with all of that in mind, Rob, what do you think will actually happen next in practice? What can firms expect?
Well, I think it's a few things. In some cases, there are consultations that have now been launched that they'll want to engage with. Often the direction of travel is clear, sometimes less so. And in some fields, parliamentary time will be needed. And the government has used its usual formulation when the parliamentary timetable allows. But we do get the impression that doesn't mean one day, it means really soon, perhaps the next parliamentary session. Will be a sensible target to have in mind. There are also some ongoing reform proposals where new deadlines have been announced. So FCA is going to look at the client categorisation rules, focusing on elective professionals, with an update in Q4. The transaction reporting regime consultation, now Q4 this year. The securitisation rule reform, the review in Q4, final rules next year. Some of those timetables have been brought forward to try to make the package coherent overall. So I think firms will need, through the rest of this year, to really engage with a whole series of interlocking reform proposals in short order.
Thanks, Rob. So certainly a lot for firms to be thinking about. Thank you for joining us today. So we're promised to move away from the cumulative burden of regulation and a government who is focused on regulating for growth and not just for risk. The Leeds reform has both diagnosed the problem and put forward its proposed very urgent solution to that problem. And we're promised a government who is going to work hand in glove with the regulator, and let's also hope the industry, in delivering on that solution and a very significant package of reforms. We look forward to continuing this discussion with all of you. Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Spotify, or wherever you get your podcasts. If you'd like more information on the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.